If you've been watching the markets, you know the story of the last few years. It's really been all about U.S. mega-cap stocks and a level of dominance that just feels unprecedented.
It's been an incredible run. We just closed out 2025 with the third straight year of really strong double-digit gains,
Exactly. And that performance is being driven by a smaller and smaller group of companies.
which is the whole dynamic of the market today, really.
And that concentration, that's what brings us to our core question for today. A listener really wanted to know, when the winners are winning this big, does it still make sense to invest in the whole market? Or should you just focus on the undisputed champions?
A great question.
That's our mission today. We're doing a deep dive into two of the biggest benchmarks, the S&P 500 and its more concentrated powerhouse sibling, the S&P 100.
Yeah, the giants versus the slightly smaller giants.
Welcome to everything you need to know about finance. And, as we get into all the data here, we have to do the quick reminder. This is just us digging into the information. It's not financial advice.
We're all about the context, not the recommendations.
Right. And if you find this kind of deep dive interesting, breaking down these complex topics, please do take a second to like and subscribe. It helps a lot.
Okay, so to set the stage properly, we have to start with the big one, the S&P 500.
The one everyone knows.
Exactly. It tracks 500 of the biggest U.S. companies. It's basically the definition of the broad market. And it is enormous. We're talking about something like 80% of the entire U.S. public market.
Which is a value of what, over $57 trillion now?
Well over that, yeah. It's a massive universe.
Okay, so let's zoom in from that vast universe. What exactly is the S&P 100? How does it fit inside that bigger picture?
The S&P 100 is, think of it as the VIP section of the 500. It's the 100 largest, most established blue chip companies.
So every single company in the 100 is also in the 500?
Automatically, yeah. It's the absolute top tier. These are the mega caps, the household names.
I've heard it called a quality first index. Is that because you're talking about companies with, huge cash reserves and global reach?
Precisely. These are the established economic engines. And to really get their power, we have to talk about how both indices work. They're market cap weighted.
Right, which is crucial. It's not just the stock price, it's the total company value.
The bigger you are, the more you move the index. And that's what makes the 100 so potent.
So what's the metric that really drives that point home?
It's the math, and the math is just staggering. The S&P 100 has only 20% of the companies.
100 versus 500, yeah.
But it accounts for nearly 67% of the S&P 500's total market value.
Wait, say that again? 67%.
67%. And it's about 61% of the entire U.S. stock market. Just those 100 companies.
Wow. I mean, that is the ultimate example of a winner-take-all economy right there. 2/3 of the broad market's value is in just 100 names.
And that's why concentration risk is the conversation everyone's having right now. But it gets even more concentrated when you look inside the 100.
Okay, so this is where it gets really interesting, right? If the 100 is almost 70% of the 500, we have to talk about the absolute biggest players, the top 10.
This is where you see extreme concentration. In the S&P 500, the top 10 companies make up about 38% of the index, which is already a lot.
Already very top-heavy.
But in the S&P 100, those same 10 companies can easily be 40, 50, sometimes even more than 50% of the entire index weight.
So half your investment in an S&P 100 fund could just be riding on 10 stocks. That's wild.
It's an incredibly focused bet.
So who are these 10 giants right now as of early 2026?
Well, it's a list that won't surprise anyone. It's very tech and communications heavy. You've got NVIDIA at the top, then Microsoft, Apple, Alphabet, Amazon.
The usual suspects.
Yep. Then Meta, Broadcom, Tesla, Berkshire Hathaway, and JP Morgan Chase rounding it out.
So the S&P 100 is making this massive collective bet that the dominance of software, AI, and e-commerce just continues uninterrupted.
It really is. The performance of the 100 is almost completely tied to how a few of those names do on any given day. If Apple has a bad quarter, the whole index feels it.
Okay, let's get practical then. If you decide you want that maximum exposure, you can't just go out and buy the index itself. So how do people invest in this? I guess this is where ETFs come in.
Exactly. An ETF, an exchange-traded fund, is basically a basket of stocks that you can buy and sell just like a single share. And the main one for the S&P 100 is the iShares S&P 100 ETF. The ticker is OEF.
And OEF has been around a while, right? Since 2000. It's pretty liquid, and the expense ratio is fairly low at 0.20%.
It's the standard way to play this.
So let's talk performance, because that's where the comparison really comes alive. Historically, how has this mega cap strategy worked out?
Historically, it's worked out incredibly well. I mean, the long-term numbers for OEF are very strong. As of the end of 2025, you're looking at a 5-year return of around 17.8% and a 10 years about 16.5%.
And what about in a big up year, like 2024?
Oh, in 2024, it was a monster. The total return was over 30%, 30.66 to be exact. It shows you the raw power of concentration in a bull market.
So that validates the strategy. But you mentioned something, an anomaly in 2025. This is the aha moment, you said. What happened?
Right. This is a super important data point. In 2025, the S&P 500 had another great year. It returned about 17.9%, but it actually outperformed the S&P 100. OEF returned about 16.4%.
Hang on, the broader market beat the champions? How did that happen?
It shows the risk of that hyperconcentration. For years, the rally was really narrow, driven by just a few tech names. But in 2025, the rally started to broaden out.
Ah, so the other 400 companies started to catch up.
Exactly. The rest of the market woke up. Maybe it was rotation into other sectors, or maybe the growth of the top 10 just started to normalize a little. Whatever the cause, it let the rest of the market shine.
And that 1.5% difference, that really highlights the value of the diversification you get with the full 500, with the big ETFs like VOO or SPY.
It absolutely does. When the market rally broadens, the 500 is in a better spot to capture that.
So what does this all mean for someone trying to decide where to put their capital? It sounds like the choice between the 100 and the 500 is really about one single trade-off.
It is. It's that classic tension between, let's say, maximum efficiency and quality on one side.
Versus broader diversification on the other.
Exactly.
Okay, so let's make the case for the 100. That's the blue chip safety argument, right? These companies are seen as the most stable, almost too big to fail.
They are. They have enormous cash reserves, global reach, and that global part is important. The S&P 500 as a whole gets about 72% of its revenue from the U.S.
Okay.
But that other 28% from international sales, that's heavily concentrated in these S&P 100 giants. That global footprint can make them more resilient, sometimes even less volatile.
But then the counter-argument, the reason to stick with the 500 is that you're buying the future, not just the present.
That's the innovation argument.
Yeah.
And the key thing people miss is that when you buy the S&P 500, you already get most of the S&P 100. It makes up, what, 65% of the index by weight?
Right. You get the giants by default.
But you also get those smaller, large-cap companies, the ones ranked 400 or 500. You get tomorrow's potential winners. It's your hedge against disruption.
That makes the S&P 500 sort of the powerful default choice. You get the current winners plus a net to catch the next ones.
And this brings us back to the biggest risk of the S&P 100. It's long-term concentration risk. If something systemic happens, like a huge regulatory crackdown on big tech,
which people are always talking about.
always, or some new technology disrupts the whole industry,
Yeah.
the S&P 100 is going to get hit so much harder because it just doesn't have that cushion from the other 400 companies.
That sums it up perfectly. The 100 is for maximum exposure to the current winners, but the 500 remains the more diversified, I guess, conservative default choice for the U.S. economy.
And looking ahead to 2026, it seems like the general optimism is still there. Most analysts are predicting another stock rally, building on the momentum we've seen.
But that concentration and the huge size of the U.S. market, it does raise one last kind of provocative thought for you to consider.
Which is?
Given how top-heavy even the S&P 500 is, and the fact that 72% of its revenue is domestic, should investors be looking beyond both of these indices entirely for true diversification?
It's a fundamental question. We saw reports that as great as U.S. stocks did in 2025, a lot of international markets actually did much better.
Right.
So maybe the ultimate strategic question isn't 100 versus 500. It's how much exposure do you really need outside of the U.S. altogether?
A great question to chew on. Well, thank you for joining us on this deep dive. We hope you'll continue your learning journey and maybe try out some of our latest episodes on related topics, like the VIX if you're interested in volatility, or the Russell 2000 for a look at small cap stocks.